audits of group financial statements. Doesn't really, and then we get into what I feel like some of the easier things. A little bit of memorization with these things, but very important topic areas for sure. So the next several sections get into all the different things that can happen on the report. You know, we read through the unmodified report. What else could happen? So the first thing, actually the first two things they talk about are an unmodified report that has an additional paragraph in it, an emphasis of matter paragraph or an other matter paragraph. There's a difference that you definitely need to highlight. And we'll get there in a second. But the deal with these two things is these things do not affect the auditor's opinion. Right? The opinion is what it is. This is information in addition to what's in the unmodified report that needs to be communicated for whatever reason. You know, modifications happen when there's a gap problem or a gas problem. That sounds bad, doesn't it? Well, I already said it. Wow. No, modifications happen if there's a gap problem, if there's a misstatement, right? Material misstatement. Modifications happen when there's a problem. Look at you laughing like you're in the third grade over there. Aren't they though?
They really are.
They're never not funny, no matter how old you get. Yeah, modifications happen when there's a problem with the audit, a scope limitation where you can't audit the things you need to audit. That's when modifications happen. These are not modifications. These are just highlighting additional information. The opinion is what it is, right? So modifications are qualified opinion, adverse opinion, disclaimer of opinion, right? So with these little paragraphs, we are referring to matters that have already been appropriately dealt with in the financial statements. Emphasis of matter is for things that are appropriately there in the financial statements or in the notes. All right, that's the key difference in the emphasis of matter versus other matter paragraph. Emphasis of matter is going to emphasize something that is appropriately in the financial statements, and we're going to highlight it in a way, and we're going to refer to it. Other matter is for things that are not in the financial statements, and appropriately so, but we're going to throw that other matter paragraph in there to say, oh yeah, here's all the financial statements, by the way, this too, right? So emphasis of matters like, here's the financial statements, be sure to check this out, that's in there. Other matter is, here's the financial statements, oh, and by the way, we got this going on as well, right? So that's kind of a simple way to look at that. So here we go. Emphasis of matter paragraph. It refers to a matter that has already been appropriately presented or disclosed in the financial statements. But in our judgment, it's so important that it is fundamental to their understanding of the financial statements, and we need to highlight it. It is required for two things here: inconsistencies in accounting principles used. So it would be like if we needed to describe a justified change in an accounting principle that has a material effect on the financial statements. You know, we might have to highlight that. Seems like there's something else I was thinking about on that. I guess not. No, I guess not. Maybe it's something that comes up in a later section. Yeah, I think it. Yeah, okay. There's a whole separate section on consistency of financial statements, right? Yeah, that's what I was thinking of. Okay, we'll get there in a minute. So, and as you'll notice through all these sections that come later, it'll always, not always, but there'll be a lot of, in this case, we would have an emphasis of matter paragraph or another matter paragraph. So they keep repeating this stuff again, because we've got a section on consistency of the financial statements, and it says the whole thing about emphasis of matter again. So we'll dig a little deeper here in a minute on that. It's also required if there's a special purpose framework that the financial statements are prepared in accordance with, and that's also in a later section. So that's two areas that it's required to have an emphasis of matter paragraph. There's other reasons you could include one too. For example, if there is uncertainty about the outcome of and the key word here is unusually important event, litigation, or something else. If there is a major casualty that has significant effect, if there's significant transactions with the related parties, you might have to do it if you feel like it's necessary. Or really just any unusually important, again, keyword, unusually important subsequent event. Now, any test question you get would need to make sure that they tell you this is an unusually important thing. Otherwise, it'd be too vague of a question. So you don't have to worry about what is unusually important versus not unusually important. That's usually the way they'll frame the question. It's like, this unusually important thing happened. What do we do? So the emphasis of matter paragraph comes after the opinion and basis for opinion sections of the report. And we'd have a little header like we do the other things that would just say emphasis of matter. And you need to refer to the, again, emphasis of matter is when something is already in the financial statements and we want to highlight it. So the report's going to specifically refer you to the point or the part of the financial statements where that is. So it'll identify where the relevant disclosures can be found. It'll refer to note whatever or something like that. And it should also state in the report that the auditor's opinion is not modified with respect to that matter. Right? If it was modified, then it wouldn't be an emphasis of matter thing anyway. It would be referred to in a different area of the report. So it wouldn't be there. So that's emphasis of matter. Other matter is, as we said, refers to a matter other than what's in the financial statements. Things that were relevant to the user's understanding, but are really not part of the financial statement package. So there's a lot of areas where this type of paragraph is required. If I'm studying, I'm not going to try to memorize this. I'm just going to kind of get a good feel for it, right? So it's because it's too much to memorize. But I don't know. I can see myself making a little study note card and just kind of listing these for the CPA exam. I probably would if I was studying for it. So it's required when the opinion expressed on the prior year financial statements is different from the opinion previously expressed due to a management correcting it. It's required when prior period financial statements were audited by a predecessor auditor whose report is not reissued. We mentioned that a minute ago. It's required when the current period financial statements have been audited and the prior period financial statements were not. They might have been compiled or reviewed, which we'll talk about later. And the report's not issued. It would be required when the prior period financial statements were not audited at all, reviewed or compiled. It would be required when the financial statements have been presented using a special purpose framework, which we'll discuss later. And then a little tidbit on that other matter paragraph would restrict the distribution of that report under some circumstances and not restricted under other circumstances. There's a section on restricting reports later too. So all of this is covered again later, but reports are restricted when it's prepared for a certain person, like a contractual basis of accounting, where you prepare everything to report in accordance with meeting the requirements of a contract or something like that. That wouldn't be for everybody. So we would have a restriction in the report. So anybody who might have gotten their hands on it would be like, oh, here's all the stuff, right? But if it's just like a special purpose framework that's more general, like cash basis or tax basis or something, there's no restriction necessary. Other matter paragraph would be required when there is supplementary information presented and the auditor does not issue a separate report on the supplementary information. That's discussed later too. It would have another matter paragraph when a report on compliance with contractual or regulatory requirements is combined with the report on financial statements. And if it's auditing financial statements of an employee benefit plan, we're really getting out there now, right? So the paragraph would have a label, other matter. And here's a good test question. Where do you stick an other matter paragraph? So it goes after the opinion and basis for opinion, like the emphasis of matter paragraph does. It goes in the same place the emphasis of matter would. If you have both an emphasis of matter and an other paragraph, it goes in that order. Opinion, basis for opinion, emphasis, other. Good test question. Kind of silly, but a good test question. It's like, why do I need that as walking around knowledge? That's just the way it goes with CPA exam. We as auditors need to communicate about the proposed wording we're going to use on any of these paragraphs, kind of get their okay on it. All right. And this is fairly new too. We now have a going concern section of the audit report if necessary. Before, if there was a going concern issue, we would add an emphasis of matter paragraph. Now we just have a going concern section if that's an issue, which I think is a good move too. It's just like emphasizing it even more than an emphasis of matter paragraph, right? So we'll stick a going concern section with the heading like that, something like substantial doubt about the entity's ability to continue as a going concern. That's a heck of a heading, but that's the kind of thing we would do. Refer to a financial statement note that discusses all the stuff about going concern, because there will certainly be one. Again, a statement that the auditor's report's not modified, because if you remember, going concern is fine. Going concern problem is fine as long as it's appropriately reported, right? The auditors are looking for fair presentation in accordance with GAAP, and if there's an appropriate note disclosure about it, it's fairly reported, right? So we would refer to the note. We would state that we have not modified our opinion, and then this is just a little tidbit off to the side, but going concern issues might be resolved. Management might have plans in place that resolve the issue. You might add an emphasis of matter paragraph in that case to kind of draw attention to it. So again, emphasis of matter, because this is an item already in the financial statements. So we refer to that with an emphasis of matter paragraph. So we got all of that material. And then we've got all of these questions, one of them. So that is just CPA Excel transitioning to all these new rules. So don't let that make you think that this is an unimportant section just because they only had one question on it. Imagine they're in the process of rewriting new questions because there were some changes here. That going concern thing is fairly new. So yeah, there you go. It's a really easy one. There's a separate paragraph following the opinion paragraph of the auditor's report, and it describes an uncertainty as follows. As discussed in Note X to the financial statements, the company is a defendant in a lawsuit alleging infringement of certain patent rights and claiming damages. Discovery proceedings are in progress. The ultimate outcome of the litigation cannot presently be determined. Accordingly, no provision for any liability that may result upon adjudication, I don't know, has been made in the accompanying financial statements. What type of audit report? Everything's cool, right? I mean, this isn't a good thing to have going on, but it's appropriately disclosed, it's appropriately accounted for. There's no reason to qualify this report. There's no gap departure. There's no scope limitation. So we're not able to qualify an opinion or do a disclaimer. It's all good as far as the way they presented it. So there you go. Questions or comments on any of this? Very good. All right. Several little easy sections now. Very basic as like this is definitely important basic knowledge to know, these next sections, because it's going to talk about qualifying the audit opinion for various reasons, disclaiming the audit opinion, adverse opinion, very important stuff. I mean, this is fundamentals, right? So, as we mentioned, we're doing our audit work. The opinion we give depends on really two things: whether we were able to do our audit in accordance with generally accepted auditing standards, GAS, and whether the company is in accordance with GAAP, right? So we will modify an opinion if there's any problems with either of those areas, right? So a modified opinion is any of these three: qualified, adverse, or disclaimer. So again, unmodified is a clean opinion. So, you know what? I think, yeah, I did. I think I saw unqualified a minute ago and changed it to unmodified, but that was on the PCAOB chapter. PCAOB still uses unqualified in their terminology, I think. So yeah, whatever, doesn't matter. We used to call them all unqualified, so it's hard for me to get away from that. All right, so this chapter is about qualifying the audit opinion for a scope limitation. So a scope limitation means we couldn't do everything we wanted to do in the audit. There was some area we could not get the evidence we needed, so it doesn't just it's not pervasive is the word they always use. It doesn't have a pervasive effect over the financial statement. It just affects maybe this little area. So it's a scope limitation, but it's not just a massive deal. So we're going to do a qualified opinion. Qualified opinion means everything's cool except for, is the words they'll use, except for this. So if it was, it could be okay. So I was just seeing this line out of my head here. So, I just mentioned all that about pervasive and everything. So if it is material and pervasive, then you just disclaim the opinion. It's like, and that comes later, but you're doing your audit work and you weren't able to do audit work on enough area to even render an opinion, so you'll just disclaim the opinion. Here, you're trying to do the audit work and you just can't audit this certain area it's material, otherwise you wouldn't worry about it at all, but it's not pervasive, right? So you just say everything's cool except for this. So things that can cause a scope limitation could be things like accounting records were destroyed. It could be things like internal controls are ineffective and you couldn't figure out how to do substantive procedures sufficiently enough to fully test it. It could be a deal where you couldn't get the financial statements that were audited of an investee, like a major investee. It might be something like you couldn't do an observation of the physical counting of inventory and there were no alternative procedures that you could do to remedy that. It could be something like management won't let you do something and withdrawing wasn't practicable or something like that, right? So a lot of reasons, but yeah, the key is it's a scope limitation, but not pervasive over the entire financial statement package, just on this little area, right? So your audit report's going to be a little different. And this is where a lot of test questions come into play. It's just about how the audit report changes. So your heading on the opinion paragraph on an unmodified report, it just says opinion. On a modified report, on this one, it says qualified opinion. So you want to highlight that with the heading right off. That's the first thing they read after their name is qualified opinion. So the language in the report now will say, in our opinion, except for the possible effects of the matter described in the basis for qualified opinion paragraph, except for that, the financial statements referred to above present fairly. Right? So everything's cool except for that. That's a qualified opinion. And that's what the qualified opinion section will say. And then you'll have a basis for qualified opinion paragraph where we'll talk about why we qualified the opinion. So we'll give a little information. And that last sentence in the unmodified opinion that says, we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our audit opinion. We would modify that slightly to say it's sufficient to provide a basis for our qualified audit opinion. It's just minor tweaking there of the wording. No change to the other sections. No change to management responsibility section. No change to the auditor's responsibility section. Those stay the same. So, yeah, with a qualified opinion, change the opinion paragraph to say, except for this, everything's presented fairly. And then in your basis, explain. Pretty easy, pretty straightforward. Good testable content for sure. Let's see what questions they put on us here. Number one. This is a new deal, isn't it? So I can keep up with where I'm at. Number one is kind of a classic. An auditor was unable to obtain audited financial statements supporting an entity's investment in a foreign subsidiary. Between which of the following opinions should you choose? All right, so an auditor was unable to obtain. That's a scope limitation. Scope limitation means you're either qualifying it or disclaiming. All right, there's no adverse opinion for a scope limitation. Adverse means there was a gap departure that was big. Right, there's no gap departure here. It's a audit problem. We can't check some stuff. So we're either going to qualify it or disclaim it altogether. Disclaiming opinion says we render no opinion on this. So the answer is D. Scope limitation would lead to a choice of those two. This is a classic question right here. Oop, what am I doing? That's not where I do that. There we go. So how about number 3? In which of the following circumstances would an auditor usually choose between issuing a qualified or disclaimer? So they're kind of going at it the opposite way here. So again, you're thinking in your head, scope limitation for those. So it's not A, departure from gap. It's not B, inadequate disclosure. That's still a gap departure. It's C, inability to obtain sufficient appropriate evidential matter. D is a gap problem too, not being able to justify a change in accounting principle. Okay, I think that's all we got on that. And 2 is really the same question again. Under which of the following circumstances would an unmodified opinion be inappropriate? A says we're unable to obtain audited financial statements of a significant subsidiary. That is a scope limitation. So that would be a modified opinion. Okay. Questions? Pretty straightforward. So that's a qualified opinion for a scope limitation. We can also qualify an opinion if there's a gap departure. Again, material departure, but not pervasive over the entire financial statement package. Just a misstatement that screws up this little area. So we don't have to go so far as to hit them with an adverse opinion. We hit them with a, except for this, everything's fine, right? So it's the same idea. Same deal on the report. The only thing in the, with a gap departure in your report, you'll, like you described, your reason for a qualified opinion, you'll try to include amounts if possible and practicable, or whatever the effect is, you can try to include that if you can. Here's a really good takeaway right here. If there's no statement of cash flows, that is an automatic qualified opinion. It's a good thing to tuck away in your little knowledge bank. If they don't have a statement of cash flows there, qualified opinion. That shows up as test questions quite a bit. And they make a note, when they're talking about trying to include, when practicable, the effects of the misstatement or any omitted information. They say when practicable, which means you don't have to supply the missing statement of cash flows. That's not your job, right? That is not practicable to do that. All right, so that's really all to say about that. It's the same idea, just a different reason for qualifying the opinion. Practicable? Yeah. That's funny. That sounds like something your brother would have said. Yeah. He would have said that. I'd say something, he'd be like, I like that word. Applicable.
It's weird when you've never heard a word pronounced. You always say it in your head.
I know.
You have to say that loud.
Yeah, things like that happen. I forever thought that it was championship. Chip. And I thought that was how it's spelled too, forever. And then I saw it in some random thing. I'm like, oh, ship. Okay. Had no idea. You don't know till you know, right?
How old were you when you figured that out?
Pretty old. Yeah. I'm talking probably in my 20s.
Really?
Yeah. I just never seen the word written before. And I've always heard people, you say it, championship. That's what you say. You don't say championship. Say it.
I say ship.
Say it.
Championship.
I still hear chip.
A lot of people, I think everybody always thought the Civil War was the Silver War.
Silver War. I've heard that many times. Yes. Mm-hmm. There's all kinds of things like that. Like you've heard people say, pique your interest. Do you know how to spell that? P-I-Q-U-E. Yeah. I've seen people write P-E-E-K all the time, or P-E-A-K rather. Just because they're like, pique your interest. Mm-hmm. See, there's another one. Chomping at the bit. How would you spell chomping? It's A. Uh-huh.
I used to think it was lick a gift horse in the mouth.
Lick a gift horse? Oh, like that.
One time, I don't remember, it was so long ago, I don't know what the conversation was, but he said seductive reasoning instead of deductive.
Seductive reasoning?
He really thought
that's great.
And he was just convinced, and we had to Google it and show him it's so
That's hilarious. Oh man. My favorite thing, I love this. Now, when a word starts getting used regularly, I guess that's what it becomes to mean. But y'all have heard the word decimated, right? Something is decimated. What does it mean? Just wiped out, right? The original meaning of that word is to reduce by 1/10, decimated. But it sounds, the sound of it's like, it's decimated. It sounds like it's wiped out. So that's just kind of what it became used as, but it originally means to reduce by 1/10.
Well, that's used a lot.
Hmm.
They use it a lot, like, oh,
Yes, I hear it all the time, and I just think, hey, use that wrong. What is that?
fireworks. I think it's the band.
Is it the band?
Is that weird? Yeah.
It's loud. It does sound like fireworks. I feel like I've got Caleb back in here now. This is the kind of tangents we would always go off on. This is good. It's familiar territory again. I love it. They only had one question here. It's fine. It's a good one. It's a long one. So ZAG company issues financial statements that present financial position and results of operations, but omits statement of cash flows. So you automatically are thinking in your head, oh, qualified opinion, no statement of cash flows. So what do? Emphasis of matter? Nope. Refuse to accept the engagement? No. Explain that we have to qualify the opinion? That's what you do. Prepare it for them? No. We do not do that. That's auditing your own work, right? Adverse opinion is a gap departure that just screws up the whole thing. It's like these financial statements are crap and they do not present fairly in accordance with GAAP, and that is that. So we got gap departure misstatements that are both material and pervasive, affect the whole deal. Adverse opinion. And you're like, why would it get to that point? Why don't they just fix it, right? So I dug around to find an example. So you might have a company that had not consolidated their financial statements of a subsidiary and instead accounted for it using the wrong method and didn't have a way to ascertain fair values of some of the material assets. They just can't yet. So it's like, here's everything. They're not fairly presented. That, there's an example. But adverse opinions would be unusual, but yeah, they can happen. So what? The opinion paragraph will have a heading that says adverse opinion. We would say something like, in our opinion, because of the significance discussed in the basis for adverse opinion section, the key here is the financial statements do not present fairly. So with the qualified, it is except for this, the financial statements present fairly. With an adverse opinion, it is they do not present fairly. And then just like the qualified opinion, we'll have a basis for adverse opinion where we'll describe and quantify to the extent possible the problems, right? And then we'll tweak the language to say, we believe the evidence is sufficient to provide a basis for our adverse audit opinion. And then no changes to management responsibilities or auditor responsibilities, which makes sense. The responsibilities are what they are. But we do tweak one of those sections for the disclaimer. Our auditor responsibility section does have a slight tweak when there's a disclaimer of opinion. Otherwise, we leave auditor responsibility and management responsibility paragraphs alone. Yeah. So what questions have we here? We have one of them. Tread Corporation accounts for the effect of a material accounting change prospectively when the inclusion of the cumulative effect of the change is required. Now, you don't really have to, in the audit test, you don't really have to know what the heck that means. You just have to be able to say, oh, they departed from GAAP, right? they accounted for it this way when they should have done it that way. You could even replace the question and say, they accounted for a material thing this way when they should have done it this way, right? So don't get hung up in the what's going on. Just broadly, they screwed up on gap. We would choose between, so with a gap departure, we can qualify it if it's not material or not pervasive rather, or we do an adverse if it is pervasive. Nice classic little question there. That's the only one we have to look at. Disclaimer. So this is a scope limitation that is material and pervasive. We couldn't audit enough to give an opinion. So we'll disclaim the opinion. So the report will have a section now called disclaimer of opinion. And we'll say something like, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. So in the unmodified one, we say, we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our audit opinion. Here, we say that we have not been able to obtain sufficient appropriate audit evidence. And then we'll describe circumstances and identify dollar amounts when we can. No changes to the management responsibility section. In the that's old material that I forgot to delete from the change. What the heck is that? Gone. Although make sure I got everything listed in the right place. Hot here. So I'm looking at a report. So it starts with a section called disclaimer of opinion. We are engaged to audit. We do not express an opinion on the accompanying financial statements is the second sentence. Because of the significance of the matters described in the basis for disclaimer section, we have not been able to obtain sufficient appropriate audit evidence. So that's all in the disclaimer of opinion paragraph, which I have right here. So we disclaim the opinion saying we have not been able to obtain sufficient appropriate evidence, blah, blah, blah. So that is all there. In the basis for a disclaimer, it says the reasoning, and it's just a paragraph of what happened, right? So describe the circumstances and identify dollar amounts when applicable. So we're good there. Management responsibilities do not change. Auditor responsibilities change pretty considerably. To make sure include, this is no longer, there's no introductory paragraph anymore. I just forgot to delete that. So the auditor's responsibility simply says, our responsibility is to conduct an audit of their statements in accordance with gas and issue a report. And then it goes off and says, however, because of the matters described in the basis for disclaimer of opinion section of our report, we were not able to obtain sufficient appropriate audit evidence to provide a basis for the audit opinion. That's the auditor's responsibility section. They don't go into the big list of things they were required to do. They just say, we were supposed to do this, we weren't able to do it. And then they might add more to that. So that is true what I have there. I just forgot to delete some of those other things. And then another little thing to add, if we're disclaiming an opinion, we are not allowed to include any other information section in the report, nor, again, there's that, we cannot include any comments on key audit matters. And I don't guess there's any good section to throw this in, but you can't do what's called a piecemeal opinion. You can't have an adverse or disclaimer on, the complete financial statement package and then have some unmodified opinion on some specific element or something, an account or something like that. You can't do that. So no piecemeal opinions are allowed. There were no questions in this section for us to look at. Lots of good material in those previous sections there. So read those reports, get familiar with the little differences in each report. That's extremely important. But very easy, very doable part of the audit CPA exam. Okay, consistency of financial statements. This we have already touched on. We'll hit it a little deeper here. We're a little bit of a repetition. So, and this is good. It's kind of a bit of a nutshell, in a nutshell type chapter. So regarding the consistency of financial statements, we as auditors need to, as always, evaluate fair presentation, right? So we need to see if consistency across periods has been affected by a change in accounting principle or a restatement. If it's a change in accounting principle, we are obviously interested in whether that change is in accordance with standards, whether disclosures are adequate, and whether they've justified the change. In other words, we're interested in GAAP and fair presentation, right? So that's it, right? As we mentioned before, we have to do an emphasis of matter paragraph to describe the change, and we would reference the footnote disclosure regarding the change. We would want that paragraph every year until the new principle is applied to all the comparative periods presented. If, however, they account for it by retrospective application, in other words, they apply to the new principle to the previous periods as if that had always been the standard. Y'all remember all that from intermediate, maybe. Then we only need that paragraph 1 year during the year of change, and then it's fine the rest of the time. So pretty obvious stuff. Basically, in a nutshell, we just want to make sure it's all handled in accordance with GAAP, and we want to stick that explanatory emphasis of matter paragraph on there. So that's a change in accounting principle. If we have a restatement of financial statements, in other words, correcting some previous misstatement, there's that emphasis of matter paragraph again. And we only need it that one time because other periods won't be affected anymore. And then I love this. Other than these two instances, we don't have to refer to the consistency of the financial statements in the auditor's report. So there you go. That often shows up in test questions, that little idea there, usually organized like except for, the auditor refers to consistency. It doesn't have to refer to consistency except for, and it'll list one of those two things type question, right? So there you go. This is a good place to mention this. I guess it is. We're talking consistency and stuff. You can issue a qualified, adverse, disclaimer, emphasis of matter, other, whatever, any of these modifications we've been talking about for one period while expressing a different thing on another period. You can do that. So you could have like unmodified prior year with a current year qualified. So we would say something like, except for the effects of whatever on the 2020 financial statements, the statements are presented fairly as of 2021 and 2020. You can do that. You could have an unmodified current year and a disclaimer on the prior year. Any mishmash of those things you could do. And you just have disclosures in the report to kind of describe all that stuff. If you're auditing the current year, but the prior year is not audited, that's kind of like a scope limitation. So you might not be able to figure out your beginning balances. And I think we have a separate section on this, opening balances, here in a minute. So you might not be able to figure out your beginning balances. So you might have to disclaim certain statements like the income statement, but the balance sheet you might could be okay on, that kind of thing. You can present comparative statements with an unaudited prior year statements, but you'll have to make sure they're clearly marked as unaudited. There's all kinds of little tidbits like this. You need an other matter paragraph too. I think we mentioned that. Same with if you have comparative statements with audited this year and reviewed last year or compiled last year. That's another situation where you need that other matter paragraph that describes a whole bunch of things. Something like the 2020 statements were reviewed by us or whoever else, and the report stated that they were not aware of any material modifications, and a review is substantially less in scope than blah, 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 all this descriptive stuff. But you can do a lot of different things as far as the opinion of this year and last year and the state of whether it was audited this year or last year and that kind of thing. There's a lot of things you can do. So I thought that maybe during the consistency of financial statements would be a good time to mention all that maybe. Let's look at their questions here. There are 4 of them, and I think they're all 4 worth looking at. When, number 1, there has been a change in accounting principles, but the effect of the change on the comparability of the financial statements is not material, what should we do? And this is something, again, I think this has kind of crept into some wrong answers of questions in the test this year. Materiality, if it's not material, it does not matter, right? So if we've got a change in accounting principles and it's not material, we don't care, right? It doesn't matter. Materiality, that's it. That's materiality. We can really streamline our talk on materiality. If it's not material, it doesn't matter. The only thing you might get is, here's something that's immaterial that might be of interest to you, and that would be an immaterial fraud, right? If it's an immaterial fraud, yeah, it may be an immaterial number, but in your mind, you're like, this is not good, and you probably want to dig into that a little more, right? So, that's a situation where materiality in and of itself, you might kind of bump up your concern a little bit, but other than that, materiality means you don't care. So I thought that was a really good question. 2, I like 2 because it kind of puts words into what the heck they're even talking about with, an example, I guess, of what's going on here. So in 2, it says an entity changed from the straight line method to the declining balance method of depreciation for all newly acquired assets. This change has no material effect on the current year's financial statements, but it's reasonably certain to have a substantial effect in later years, right? That's off into the future. If the change is disclosed in the notes to the financial statements, the auditor should issue a report with what? Unmodified opinion. It's not having a material effect on anything you're presenting right now. It'll affect something in the future, but the future is the future. And, really a change in the depreciation method is essentially a change in estimate anyway. And they disclosed it in the notes. We're good. Unmodified is fine. In this case, for sure. It's a good question. 3 says when there's been a change in accounting principle that materially affects the comparability and the auditor concurs with the change, what should we do? Do we need to concur explicitly with the change? No, we don't have to be like there. We concur with this change. That's not up to us to make that statement. Do we qualify the opinion? What we're talking about. Change in accounting principle, material, affects comparability, concurs with the change. So we're fine, right? There's no gap departure. We concur with the change. I figure it's properly disclosed in the notes. We would assume that, right? So no, we don't issue a qualified opinion in this case. There's no gap departure. Would we have an emphasis of matter paragraph? Yes, we would, to highlight that. That is required. And then we'd refer to the note disclosure as well. That's a good question too. And 4 is good too. In the first audit of a new client, an auditor was able to extend auditing procedures to gather sufficient evidence about consistency. What should we do? This is not one of those 2 circumstances where we're concerned about referring to consistency. So we don't refer to consistency in the auditor's report. Good questions for that section, I thought. Then we got a PCAOB's viewpoints on that. I didn't see anything worth adding to the discussion. And the questions are similar, except it's just for public company audits, I guess. One says when there's a change in accounting principle, the auditor should evaluate whether all of the following criteria have been met, except for whether what. So which of these do we not care about? I think this one's a little tough to answer on the first run through, because reading all 4 of them, you're like, I guess all those matter. So A says, we're looking for the one we're not concerned with regarding this. A says we're concerned with whether the change has been authorized by those charged with governance. And that's the answer, because if it sounds like we would be concerned with that, but authorization is really not something we're going to go looking at on a change in accounting principle. That's not really something we're going to test for proper authorization, right? It's just kind of, if it happened, it's fine, and there's not going to be oh no, that didn't get properly authorized, right? A little tricky of a question though, because you really have to kind of think along those lines and be like, oh yeah, I guess they wouldn't test for authorization there. But we would be interested in the other things. We do want to make sure the method conforms to GAAP, obviously. We do want to make sure there's adequate disclosures, obviously. And we do want to make sure management has justified this principle is suitable or preferable to the other one. So you can throw out the other 3 and land on the first one regardless. 3, management has not justified the alternative accounting principle. So now we got a gap problem, right? What should we do? Gap problem means we are deciding between qualified opinion if it's material but not pervasive, or an adverse opinion if it's material and pervasive. So there's just another question similar to ones we've been doing. Those are classics. Opening balances. So we're talking initial, this is the first time we've done this audit, which means our beginning balances, which are the same as the ending balances from last year, are things we have not audited ourselves, right? So what's our responsibility regarding those opening balances? In other words, last year's numbers. And that's important because that comes into play for things like cost of goods sold, right? Beginning inventory plus purchases minus ending inventory equals cost of goods sold. Statement of cash flows captures the changes in receivables, changes in inventory, changes in all these things. So those opening balances are important. So as an auditor with this new audit, what do we need to do regarding those last year balances, which are our opening balances for this year? We need evidence about whether they are good, right? At least in a materially speaking, right? We need evidence about whether those balances have misstatements that affect the current period financial statements. We need evidence that the accounting policies that are reflected there are consistently applied in the current period, right? So we're going to need to read the most recent financial statements, any predecessor audit report for any information relevant to those opening balances. We need to get management to authorize the predecessor auditor to respond to our inquiries. We've talked about that early in the semester. And we just, in a nutshell, we need to evaluate those opening balances. When we do our audit report, and this is kind of the takeaway for this section mostly, we don't refer to the predecessor's auditor work or report it as a basis for our own opinion. So in a nutshell, we just need sufficient evidence about the opening balances. That's really all we need to say. If we can't get sufficient evidence about the opening balances, then we might have to qualify or a disclaimer like any scope limitation. We can't audit those, maybe. So it's a scope limitation. If there's some material misstatement, then we've got a qualified or adverse opinion like any misstatement. So there's really no new information here. It's just kind of highlighting, oh yeah, in case you're wondering, with opening balances, you need evidence about it. If you can't, modify the opinion. Right? That's about it. I didn't really see any of the questions worthy of our attention on this one. There were four of them, but they're just all kind of straightforward. Four, though, and we've mentioned this several times, but here's an actual question that discusses it. It's a good one. We were engaged to audit these financial statements for a new client. We have sufficient evidence for all of their things on the financial statement except for opening inventory. We could not verify January inventory. What will we do? Balance sheet is fine, right? That's ending balances. Disclaimer on the income statement, because we cannot be satisfied that cost of goods sold is appropriately captured there because we don't know beginning inventory, right? So there you go. Good question. No questions on this next one. Other information in an annual report. So we're talking stockholder stuff, annual report information for them. What about other information, so-called? So we're talking things like annual report stuff, the chair statement, the management report, commentary, financial review, operating review, internal control reports, summaries, highlights, financial ratios, data about their employees, names of officers or directors, quarterly data that they might highlight selected tidbits on. Other information in the financial or annual report, rather. What about that kind of thing if we're an auditor? So our concern really is that everything that's issued along with the audited financial statements, we don't want anything that could undermine its credibility. So we need to read it for looking for any material inconsistencies or material misstatements. So we'll get a written acknowledgement from management to kind of say what all documents are in the annual report. We got to read through them, make sure they're consistent or not materially misstated. And we are not responsible for searching for any omitted information, and we're not responsible for completeness of it. We're just looking for inconsistencies. They always say inconsistencies and misstatements, but I figure inconsistencies would capture that, right? If it's misstated, then it's inconsistent with what's there. So if we find any problems, we'll ask management to deal with it. If management won't deal with it, we'll go above them to those in charge of governance. If it won't get remedied, then we'll withhold the report and or withdraw from the engagement. They need to fix it, basically. But as far as our audit report goes, once we've done this work, we'll have a separate section in the report under, or after rather, the auditor's responsibilities. I call something like other information. And we'll make sure that we state that management is responsible for other information. We'll identify that information. We will disclaim an opinion on that information. So that's probably the most important thing. We are not rendering an opinion on any of this. And then we will say, hey, we're responsible to read it, to consider any inconsistencies. And then we'll say if we conclude there are any, then we have to describe them. So that's kind of the way we tackle that. We just say we're disclaiming an opinion on this. We're responsible to read it. If we find anything wrong, we have to describe it. Just kind of leave it at that. If we have a disclaimer on the financial statements as a whole, we don't even need that other information section. We've disclaimed everything. Right? That's that. Just a little tidbit section. Less important than the others, I would definitely say. Supplementary information related to the financial statements. So we got this section, which is supplementary information related to the financial statements. The next section is required supplementary information. So there's a difference. We're not talking about required supplementary information here. We're talking about things that they include that are not required and not necessary for the finance. You know, they're just it's supplemental stuff that they included. So we are evaluating and reporting on whether it's fairly stated in relation to the financial statements if we're engaged to do that. This is like a separate engagement. We don't normally report on supplementary information, but if we're engaged to do it, then we will. And obviously, we wouldn't be engaged to do this unless we had audited the financial statements themselves ourselves, right? You know, you're not going to get some random other person to report on this. But we wouldn't do any of this if there was an adverse opinion or a disclaimer. So other than that, kind of obvious statements there, we would be separately engaged to do this if we had already audited the financial statements and the supplementary information was derived from it. But we can't do it if there was a disclaimer or an adverse opinion. Examples of this stuff, you know, again, it's stuff outside of the basic financial statements, stuff that's not required, but they included it anyway, like a certain schedules, investment schedule, property schedule, that kind of thing. So we'll do some little limited things. We'll do some inquiries of management. We'll, as we would anything, get an understanding. We compare and reconcile the information to the financial statements, look for appropriateness and completeness. So a little more than the other information from before, because we're separately engaged to do this. We get written representations for management. So just a few little things to do, nothing major. And as far as the report goes, we could do a separate report or combine it into the regular report and have a little set heading for supplementary information. And again, adverse or disclaimer, we're not allowed to report on supplementary information. So you'll find that to be true for a lot of things. Adverse opinion, disclaimer of opinion. You don't want anything to get in the way of what you got going there, right? And again, why do people care if supplementary information is consistent with an adversely presented set of financial statements anyway, right? They don't. So that's that. I don't think there were any questions. Yeah, there was one question. Oh, this one makes a subtle but kind of important point. If supplementary information in a document accompanying the basic financial statements has been subjected to auditing procedures, the auditor may include in the auditor's report on the financial statements an opinion that the accompanying financial information is fairly stated in, and this just kind of gives you an idea of the language. It would be not in accordance with GAS, you know, financial statements are not ever in accordance with, fairly stated in accordance with GAS. That's auditing stuff. And we're not going to say it's fairly stated in conformity with GAAP, because these are just supplemental schedules. We're not really looking for saying these are GAAP. What we're going to be saying is they are fairly stated in all material respects in relation to the financial statements, which we have audited, and those are fairly presented in accordance with GAAP, right? So it kind of gives us the language they would use. And it's not in accordance with attestation standards either. That's wrong the same way A is wrong. Okay, so that's supplementary information that's not required or necessary, but they wanted to include it. But the next section is required supplementary information. So this is stuff that has to be included in the financial statements. And we'll do some procedures on that, limited procedures, but some. So, you know, don't get hung up on what are some examples of this. They'll always kind of feed it to you and describe it as, I put a little note here, test questions typically describe the situation as outside of the basic financial statements, but required by FASB. But an example would be certain disclosures about pensions might have to be made. Yeah, don't get hung up on examples. Just look for a description of not part of the financial statements, but required supplementary information, right? So we'll do some descriptions in our report. The big thing is, again, looking for consistency with the audited financial statements. And then we'll have a required supplementary information section in the report. It would not affect our opinion on the financial statements as a whole, because it is supplementary information. It's outside of the financial statements. So I think there might have been a question I've seen, if not part of what we've got here. No, there are no questions here, but I've seen a question in the past where they were asking, you know, they presented a situation where the required supplementary information was not consistent with the financial statements. And one of the answer choices was we need to qualify the financial statement opinion. No, our opinion on required supplementary information would never affect our overall audit opinion on the financial statements, because it's outside of those. So yeah, we're good there. But yeah, you know, we do these little limited procedures would be things like inquiries and written representations from management. We would read it for consistency and that kind of thing. So a lot to add with that little section. PCAOB, a little different. We are required to do specific audit procedures to test that supplemental information. That's about all. So we can add that little tidbit there. And they gave us 3 questions here, all worth going over, I think, since we didn't get any from the other section about required supplementary information. One says the auditor's report on supplemental information under PCAOB standards should include a statement about each of the following except for what? A says a statement that supplemental information is management's responsibility. So we're looking for the thing that we would not include. In other words, the thing that's, well, the thing we shouldn't do. This is an interesting one. It's a little carryover from an earlier section more than this section. But B says we should not include a statement that the methods of measurement and presentation have not changed from those used in the prior period. So a little deeper thinking on this is that's a comment about the consistency of the financial statements from year to year, which we said there's only 2 reasons we would do that, right? And this isn't one of those reasons. So there you go. It's an interesting little question. but the others are fine. It is management's responsibility. Statement that the supplemental information complies with the applicable regulatory requirements. You know, is a tough question to really get at. But yeah, a little deeper thinking, you know, we may not automatically know this, but we can reason that that would certainly be fine. They wouldn't give us a question that said, oh, no, you don't have to do that, right? And then D is an opinion or disclaimer as to whether it's fairly stated in relation to the financial statements as a whole. We know that's something we'll do. So we really would be between B and C. And based on our knowledge about reporting or not reporting about anything about consistency of financial statements, we should land on B. 2, in reporting on supplemental information under PCAOB standards, the auditor's procedures should include each of the following except for what? So our procedures. So we're thinking in our head, I forgot what the answer is without looking, but as I'm reading this, I'm thinking, all right, limited procedures, inquiries, written representations, read it for consistency. So I'm thinking probably they're going to have some hardcore audit procedure here that we're going to rule out. I don't remember. Let's see. A says we need to obtain an understanding of the purpose of the supplemental information and the criteria used by management for its preparation. Sounds okay. Always good to obtain an understanding. B says we're going to inquire of management about significant assumptions or interpretations. Inquiries are good. C says obtain written confirmation. Sort of like, well, that's too much. Written confirmation from the regulatory authorities that the supplemental information complies with regulatory requirements. That's too much. All right. We don't need to go overboard on this. So that's the answer. D says verify it reconciles with the underlying accounting records. So it's a very good question there. 3 says the definition of supplemental information includes all of the following except, yeah, this is not worth looking at. Well, I guess it is. Supplemental information would be supporting schedules, things derived from the accounting records, things required to be presented under regulatory rules, but we wouldn't want a public company sustainability report with all this non-financial stuff. That's more of a other, what do we call it from the annual report, other information. That would kind of fit into the category of wherever that was. Whatever, the annual report stuff. Yeah, this other information in the annual report. It's not really supplemental information that ties into the financial statements or anything like that. Okay, that's that. Quick little section here, alert to restrict the report, and we touched on that a minute ago too. We might restrict a report if we were using some oddball basis of accounting, like a contractual basis of accounting, specifically for this person to report in a way that shows compliance with some contractual agreement. That wouldn't be for everybody, right? That would be for the people we're doing it for. There might be cases where we're reported under some regulatory basis of accounting, again, to show that we're complying with whatever their things are. There are some regulatory forms of reporting that are for general use. We wouldn't have to restrict those. So what we're talking about here is restricting that type of report where it's just for a few people or one person or whatever. So if that's the case, we, the auditor, should restrict the use of our communication by including an alert. That would be like a separate paragraph in the report at the end of the report. We don't have to enforce the distribution of it or anything like that. We just stick a line on there and call it a day. So that is what we would do. And the only question is a simple question about where to put that in the report. So we will put it at the end. There you go. So quick little area or quick little chapter there. And another really quick one. Financial statements using another country's framework. So we can really streamline this and say, if an audit report is to be used solely outside of the US, we, the auditor, have to comply with GAS except for the report itself. We can issue the report in accordance with whatever country's going to read it and understand it, right? But that doesn't mean we don't have to do our audit in accordance with GAS. So GAS audit, definitely. Report, we can tweak and do it in terms of wherever it's going to be released. Only if it's only going to be used outside the US. If it's to be used inside of the US at all in any little tidbit of an area, then we got to report using the US form of the report. And we would do emphasis of matter, paragraph, if it was a different framework, etc. Real quick and easy section.
Would that be like if you had a foreign subsidiary for some reason?
Yeah. It could be something like that. You know.
Do people from other countries ever ask the United States auditors to do their stuff for you? What would be the reason? Would they do that?
Think about this. So if it was like a foreign company that needed a audit for, US investor, yeah, absolutely, something like that, if it's a company that's only going to be needing an audit for use in that country only, then they're like, yeah, this is where we need to do it. But yeah, if it's wider need, then yeah, absolutely. The US audit, yeah, usually it's like some foreign subsidiary where words out. Report might be used in the US, and yeah. Or I guess you're asking more about it being used outside of the US. Why would they do that? At the report.
I guess just what situations would this apply?
Yeah, I don't know an exact example, but yeah, I mean, we've got these big audit firms that do a lot of things, and ask them to do it. I think I know of anything else to say for this section. So, there's two questions. One says, and this is all very straightforward, so there's probably no point. Well, this was pretty good. So the financial statements of this US entity is prepared for inclusion in the consolidated financial statements of a foreign parent. So there's all kinds of weird situations like this. I just couldn't kind of think one off the top of my head, but yeah, you never know what kind of situation there is. But here we've got a foreign company getting an audit of a US entity. Financial statements are prepared in conformity with accounting principles generally accepted in the parent's country and used only in that country. So that might be an example of exactly what you were asking. Maybe not. Pretty complex. Anyway, how may the auditor report on these financial statements? So it's a US entity, but the report's only going to be used in a foreign country. So do we need a US style report? Do we need a US without revision? Do we need a US style report revised to reference the accounting principles of the parent country? Do we need the report form of the parent country? All right, so yes, it's an American company. Nobody in America is going to be looking at this. It is for the foreign country. We're not the only people in existence. So, we got these foreign countries with American subsidiary. They want this information for use in their country. They're not really worried about U.S. everything, right? So we don't have to have a U.S. style report without revision for them. That's not what they're interested in. They're interested in a setup similar to what they in their country are doing, right? So no, not a U.S. report without revision. Yes, a U.S. style report revised to reference the accounting principles of the parent country. Yes, report form of the parent country, because it's not being used at all. Yeah, there it is, are only for use in that country. So there you go. All right. Again, this is not a super important area. It's just a quick area to touch on. That ends week 10.